Hello and welcome all of you to yet another question in AFM Advanced Financial Management, where we'll be targeting a Section B question on investment appraisal today. This question is again a past exam question on international NPV, and it will help you to revise and clear quite a few concepts in that particular topic. Now, this is from a past exam, September, December 16, that cycle, and we are talking about evaluate the financial acceptability of the investment in Milan and calculate and comment on the investment's duration. So there are two things that they want you to comment. First of all, they want you to comment on financial acceptability, which means you will have to calculate the NPV. And then they also want you to calculate and comment on the duration of the investment. Okay. Now, duration, there's a separate formula. We'll get into that. But let's read the background first. Fernhurst Company is a manufacturer of mobile communications technology. It is about to launch a new communications device, the Milan, which its directors believe is both more technologically advanced and easier to use than devices currently offered by its rivals. The first paragraph gives you a background about the company. It is not contributing towards the final solution of calculation of NPV. The Milan will require a major investment in facilities. Fernhurst Company's directors believe that this can take place very quickly and production be started almost immediately. Fernhurst Company expects to sell what? It expects to sell 130 to 500 units of the Milan in its first year. Sales volume is expected to increase by 20% in year 2, 30% in year 3, and then be the same in year 4 as year 3 as the product reaches the end of its useful life, which means this is a 4-year project. The initial selling price in year 1 is expected to be 100 per unit before increasing with the rate of inflation annually. Now, this first paragraph, I think, has given us a lot of information about the inflow side. That is, the sales that you will generate, the year on year growth in volume, and the selling price in year 1. The variable cost of each unit is expected to be 43.68 in year 1, rising by the rate of inflation in subsequent years annually. Fixed costs are expected to be 9 lakh in year 1, rising by the rate of inflation. So you have fixed cost expected to rise by 9 lakh. The initial investment in non-current assets is expected to be 1 crore 60 lakh. Fernhurst Company also needs to make an initial investment of 10 lakh 25,000 in working capital. The working capital will be increased annually. So there is a working note on working capital. It will be increased as per the rate of inflation. Fernhurst Company will also incur one-off marketing expenditure of 15 lakh post-inflation after the launch of Milan. The marketing expenditure can be assumed to be made at the end of year 1 and be a tax allowable expense. Perfect. Fernhurst Company pays tax on profit at an annual rate of 25. Tax is payable in the year in which the tax liability arises. So if you have earned income in T1, then tax is also payable in T1. Tax allowable depreciation is available at 20% on the investment in non-current assets on a reducing balance basis. A balancing adjustment will be available in year 4. The realizable value of the investment at the end of year 4 is expected to be 0. Okay. The expected annual rate of inflation in the country in which Fernhurst Company is located is 4% in year 1 and 5% in years 2 to 4. The applicable cost of capital for this investment is 11%. Fernhurst Company's finance director has indicated that besides needing a net present value calculation, he also needs to know the project's duration to indicate to the board how returns from the project will be spread over time. So basically, so far we have information about the project, the cash inflows and outflows. Now, one step that I find very useful when I'm working on these questions is I start with making a list of all the working notes. And as I read the paragraph, I should keep on making a list of working notes. That is my first rough work. So I will need a working note on sales. Okay. Then what else will I need a working note on? I will need working note on variable cost. I will need a working note on fixed cost. I will need working note on tax allowable depreciation. I will need uh, a working note on working capital. Basic, these many five working notes are non-negotiable for me in this case. Okay, so that should be the starting point of our rough work. At least get an understanding of what all working notes you are going to prepare, so that when you start solving the question, actually you are not running in different directions. You know exactly what is expected out of you. And of course, as and when you solve the question, if other requirements become prominent, then you make a working note on those as well. Our first working note is the one on sales. Now, if you observe, they have specifically told you that in year one, you expect to sell 1,32,500 units. They have given you the year on year growth in sales volume. So let's write that down first. Then they have given us the sales price. So let's make a list of that. Okay, this will involve quite a few working notes, so best to, you know, make them in a sequential manner. Making a list of the working notes often ensures that you don't miss out on any single calculation. Let's start with sales. This is serial number, particulars. This is a 4-year project, right? So year one, year two, year three, year four. Year one, year two, year three, year four. Now, number of units sold is 132,500 in year one. Units sold 132,500. And then this number has grown by how much? It has grown by 20% in year two. So this is 132,500 plus 20%, which is 1,59,000. And then if you observe 30% in year three, and then be the same in year four as it was in year three. So here record a 30% growth in sales volume plus 30%. And then they've specifically said that sales volume in year four is the same as year three. Now, let's talk about the selling price per unit. Okay. Now, selling price in year one has been given to you is 100. Okay. And this 100 is in year one. And then they are saying that it will increase annually with the rate of inflation. Have they given you the rate of inflation? I believe they have. The expected rate of inflation in which Fernhurst company is located is 4% in year one and then 5% in years two to four. Okay, so when you are moving from year one to year two in year, so 100 is the price that you get at the end of year one. Okay, this is the selling price expected to be 100 per unit in year one before increasing with the rate of inflation annually. So now you will have to add the impact of inflation in this. In years 2, 3, and 4, the rate of inflation is 5%. Okay, 100 is the price at the end of year 1. Then you go to year 2, there is an inflation of 5%. So this plus 5%, then 5%, and then another 5%. Okay, and then you get your total sales. What is total sales? A into B. 132 500 into 100. You get year on year sales calculation. Okay, now what was the second working note that we had noted? We had written down that there is a variable cost of 43.68 in year one, rising by the rate of inflation in subsequent years annually. And years 2, 3, 4, the rate of inflation is 5%, so it will move in line with that. Let's get that part in place. Calculation of variable cost. Units sold remains the same, but here you have your variable cost, which was 43.68 in year one, followed by a 5% inflation and, excuse me, total variable cost is now available with you. Now, let's see if we can get the calculation for fixed cost in place. calculation of fixed cost. Now, what is the fixed cost in year one? Year one fixed cost is expected to be 9 lakh, then increasing annually according to the rate of inflation, which is 5%. So here what I'm going to do is fixed cost, which is 9 lakh in year one, grows by 5% in the subsequent years. Okay, so now out of my 5 expected working notes, sales variable, 5 working notes, I have finished 3. Now there is something on tax allowable depreciation. Okay, now Fernhurst company pays tax, and yes, tax allowable depreciation is available at 20% on the investment in non-current assets on a reducing balance basis. Balancing adjustment will be available in year 4. Let's quickly get the working in place for tax allowable depreciation. Working note 4, calculation of depreciation and tax saving on depreciation. Cost of asset, this is at start of year 1. What is initial investment in non-current assets is expected to be 1 crore 60 lakh. Okay, so 1 crore 60 lakh less depreciation for year 1, which is at the rate of 20%. So this into 20%. WDV at end of year 1, which is the same as start of year 2. How much is that? 1 crore 60 minus 32. Okay. Then depreciation for year 2, again this into 20%. 25 lakh 60,000. Then WDV at the end of year 2, which is the same as start of year 3. This is one of the easier questions, by the way, in your exam kit. Again, this into 20%, 20 lakh 48,000. And now you have WDV at the start of year 3, start of year 4, which is nothing but the end of year 3. The asset value is 81 lakh 92,000. That is your tax written down value. They have specifically sold that the realizable value is expected to be 0. Realizable value is 0. So you have your balancing allowance of 81 lakh 92,000. Okay, now for each of these years, you have tax allowable depreciation that you have calculated, and on that you will have to calculate the amount of tax saving. Okay, or you know what, we can have another approach also where we don't necessarily consider this. Let's go with the profit approach. Okay, we can do that as well, not a problem. Let's go with the profit approach. We have all the figures in place. Now let's see if there's anything else. Yes, there is an adjustment on working capital as well that we have to consider. So working note 5 is working capital. Okay, now working capital, let's write down what we know. What information has been provided to us? This specifically says that working capital matlab immediate investment of 10 lakh 25 start of year 1, and it will be increased annually at the start of each of the years 2 to 4 by inflation rate, and is fully recoverable at the end of the project's life. So I'm going to call this working capital requirement. Okay, and instead of calling this year 1, I will call it start of year 1, start of year 2, start of year 3, and start of year 4. Okay, so how much working capital do you need at the start of the year? You need 10 lakh 25,000. Start of year 1. Now, during year 1, the rate of inflation was how much? During year one, the rate of inflation was 4%. 10,25,000 is required at the start of year one, that is on T0. Now, year one goes by and there is 4% inflation. So, this into 4% inflation. And then from year after that, the rate of inflation is 5%. So, this plus 5% and then this plus 5%. This is working capital requirement. I will get my working capital flows. Okay. And then there will be release of working capital this much when at the end of year four. So that is the basic expectation of working capital calculation. Okay. Now I think we should proceed to uh, the calculation of net present value. Here, there are two approaches that we can take. One is the profit-based approach. The other one is the cash flow-based approach. I'll show you both the approaches. Okay. So, calculation of net present value. Okay. This is approach one, profit-based approach. So, what you're going to do in this one is you will write down, you will create, you will calculate the net profit, you will calculate tax on that, and you will take the discussion from there. There is another approach, which is the cash flow based approach. I'll show you that one also. Not that there is much of a difference in the two. Okay. So let this be the amount of initial investment. How much is the amount of initial investment? 1 crore 60 lakh. B. Sales. You have calculated sales. Then you have variable cost. You have your fixed cost. And see, you first of all, the thing we want to calculate is the amount of profit. Okay. Then there is marketing cost, if you observe here. But marketing cost, one of marketing expenditure incurred in year one at the end, which was 15 lakh. You did not incur it again. It was a one-off expenditure. Okay. Then fixed cost, marketing cost, followed by depreciation. Okay. Tax allowable, depreciation. 32, 2560, 2048, and 8192. That is balancing allowance in the last year. With that in mind, what will we get? We'll get profit before tax. This is profit before tax. Okay, not cash flow. B sales minus C variable cost minus D fixed cost minus E marketing cost minus F tax allowable depreciation. Okay, now on profit, of course, I'll calculate my tax. What is the tax rate? The tax rate here is 25% paid in the same year in which the liability arises. Tax at the rate of 25%. This is row G, which is profit before tax into 25%. So this into 25%, I will get profit after tax. G minus H. Now, see, I have profit after tax, but I need my post-tax cash flow. So, post-tax cash flow will be profit after tax plus the amount of tax allowable depreciation, which is your non-cash expenditure. Going back to, when you used to prepare cash flow statement, your starting point was always profit before tax. To that, you would add all the non-operating, non-cash expenses. Here, depreciation is your non-cash expense, and you need cash flows for NPV calculation, right? So, profit after tax plus the amount of depreciation will give me my post-tax cash flow. Okay, post-tax operating cash flow. This is basically from the main operations of the business. Okay, now I also have my working capital flows here. Okay, how is my working capital flow? I have already had a separate working note on that. So I'm just going to include the working capital flows. And then there is release of working capital at the end of the year, at the end of the project life. Okay, now let's calculate the total cash flow. The total cash flow is post-tax operating cash flow plus working capital. And of course, how could I forget my initial investment? A, post-tax operating cash flow plus minus the amount of working capital. So now I have my total cash flow also. The applicable cost of capital for this investment appraisal is 11%. Discounting factor at the rate of 11%, 1 upon 1 plus 11% raised to 0, 1, 2, 3, 4, raised to 1, raised to 2, raised to 3, raised to 4. N, my present value. Present value is rho L into rho M. Okay. So I'm giving my net present value, PV of inflow minus PV of outflow, which comes down to 77,97,990. Now, of course, these calculations, the correctness of these calculations depends upon how appropriately you have calculated the numbers before that. Okay, so with this in mind, I think you will now have a clear idea on how exactly is the net present value calculated and what exactly are you supposed to do when you are confronted with such a question in the exam. It's okay if you take the discounting factors from the discounting factor table, uh, makes no difference at all. And of course, the final answer will be slightly different, but that is on account of rounding off, and you will not lose any marks because of that. There is one more approach to solving this question, which is the cash flow based approach. I will also prepare a separate solution for this on the basis of the cash flow based approach, but this approach more or less will work in your exam. The theory part to this question, we'll also take that up separately. Okay, the duration calculation is the second numerical aspect. The theory part will take it up separately. You know how is duration calculated, right? Duration is the weighted average cash, is basically weighted average cash flows divided by the present value of all the cash flows. है ना? So the same thing you are supposed to do here when it comes to calculation of duration. Calculation of duration. Okay, so I'm going to first of all write down the present value for each of the years, and then of course follow it up with a formula. It's a relatively straightforward calculation that way. So again, year, so I'll take this from here. Year one, year 2, year 3, year 4. Okay, year 1, say you take these values, and now, of course, with the duration calculation, you apply the formula and you will have your answer in place. So write down the year 1, 2, 3, and 4. Okay, now DCF, that is discounted cash flow, into year. Take the total. This is now time weighted. Okay. And your duration is going to be summation of DCF into year, that is time weighted cash flow, divided by present value. And your duration comes to 2.78 years. Okay. The theory part of this question and other questions, we'll be taking that up separately. Thank you so much. And I'll be back with another question on calculation of NPV in investment appraisal.